Hey, it's Jim, and this is level 1 of the CFA program, the topic on financial statement analysis and the learning module on analysis of long-term assets. You may be tempted to think that this is a learning module on machinery and equipment, and although we do talk a little bit about that somewhere in the middle of the slide deck, the focus is on intangible assets, and you'll see that as we look through these learning outcome statements. There it is in the very first one. Intangible assets, and then we'll have to have a conversation about impairment and derecognition. And then I'm guessing you've noticed that the Institute is very big on the final LOS in many of these learning modules on things like monitoring and editing, and in this case, disclosure. So let's go ahead and get started on intangible assets. There's a good definition. Non-monetary assets without a physical substance. But the key word there is identifiable. There are a bunch of examples. I'm guessing that you know those. I'll go ahead and give you my favorite patent during my lifetime is the patent on Honeycrisp apples, which lasts for, I think you get plant patents for 20 years. So this occurred from 1990 or so for 20 years. And so back in those days, you could only get these Honeycrisp apples from this special farm in Wisconsin or Minnesota somewhere. Nowadays, you can get Honeycrisp apples wherever you go. If you haven't had a Honeycrisp apple, there's your homework assignment. Go buy one at your local food store. They're expensive, but I promise you, they're worth it. Now, as you might guess, the international people and the U.S. people have very, very similar ideas, but the Institute is probably not going to test you on those similarities. They'll probably test you on the differences. So under the International Financial Reporting Standards, that definition is identifiable, meaning that it can be capable of separated from the legal entity from, whatever the contract is or whatever those legal rights are. So, you can separate it. Can you separate the Honeycrisp apple and the farm from the patent? And it sounds to me like you can. Under the control of the company, that makes perfect sense. Expected to generate future economic benefits for that 20-year period. Now, look down at the bottom in blue there. The accounting treatment depends on the method of acquisition. So you can do this one of three ways. I'm guessing the Institute's probably not going to say, is it A or B or C, either orange or red or purple, but they'll probably tell you it's one of those three, and then tell me how we report those from a financial perspective. I'm going to switch over from the Honeycrisp apple example to, of course, my favorite. Those of you who pay attention to any of my videos know that I have lots and lots of James Bond examples. So I did a little bit of research, and I found out that 007 is a trademark which was trademarked by the two producers of that first James Bond movie, Dr. No. Broccoli and Saltzman. And it was interesting because Ian Fleming, who wrote the novels, didn't think to do that. And so these dudes who made the movies. So clearly that was kind of developed internally. But then one of the guys, Saltzman, he got into bankruptcy or something in the mid-60s or maybe even later than that. And so he sold his half of the share of the whole James Bond stuff to United Artists, which is, some kind of a movie making company. So there we go. Look up at the top in orange, purchased in situations other than a business combination. So that was kind of that kind of a scenario. And then what happened is that United Artists was then taken over by, I think, MGM at some point in the 70s maybe. So that was acquired in a business combination. So you think of the James Bond, the 007, it was developed internally and kept internally by Cubby Broccoli. But then Harry Saltzman sold and sold and sold again. So you have all three of those. I can't imagine the Institute would give you a James Bond question, but if they do, you'll be ready for it. All right, so here's some good details here. And there's a question or two at the end of the learning module about one of these three. So if the intangible asset is acquired in some kind of a situation, like a purchase, then what both international and the U.S. people think of is exactly like a piece of machinery or equipment recorded at fair value, and that is probably going to be whatever that purchase price is. If there are several patents or trademarks in there, then you probably have to allocate it. And then you get into this judgment. That's why we have that second diamond point down there at the bottom right, because if it's just one patent, if you buy that Honeycrisp apple patent, whatever you pay for it, well, that's what it is. But if there's a Honeycrisp apple patent and a cucumber patent and a tomato patent and whatever else, if you buy all those for one price, then you got to try to figure out. And so there's some judgment assumptions. Can't imagine the Institute would ask you about judgment there from a mathematical perspective, but they might throw something in there about judgment. All right, here's where they differ. So look up at the top right. This is a legitimate exam question. So the international people, they say that the research expenditures, they have to be expensed. The development costs, they should be expensed. However, they can be capitalized under certain criteria here. And let me go to this next slide here. So down at the bottom, there's some examples of the certain criteria that might be met for those costs to be capitalized. Some definitions down at the bottom right. Make sure you know what research phase is and development phase. This is likely to show up on the exam as one of those statements or comments or concluding remarks that some analyst makes or somebody from the company makes, and you'll just have to kind of determine whether you agree or disagree with it. So make sure you know those two definitions. And then acquired in a business combination, this is what we always think of as goodwill. So if I have Jim's concrete company and it's worth 100, and you guys pay me, you take over my company and you pay 140, well, what do? You're paying me for 100, but then where does that extra 40 come from? Well, the accountants call that goodwill. So notice the second diamond point, the embedded one. If the purchase price is greater than the total fair value, that thing is recognized as goodwill. A lot of times you can't separate the goodwill from the actual company. You pay that $40 extra for my Jim's concrete company. Is it because my concrete is really, really good, or my management staff is pretty good, or so it's not separately identifiable. Now, the international people, they want us to think of this in a slightly different way. Is it identifiable, intangible, and is it recognitional inside of that criteria? Otherwise, you just count it as goodwill. So what the U.S. people do is say, hey, two criteria arise from a contract, or it's separate from the acquired company. And there are some separate examples down at the bottom right. So think about this. We've got the physical assets down on the bottom left of the balance sheet, and then we have these intangible assets down somewhere in the bottom left of the balance sheet. And so what happens over time? Well, what we know is that we invested in those things as the business only if they had positive net present values. Well, what happens if over time that positive net present value turns into a negative net present value? Now, the learning module doesn't couch it in that kind of terminology, but that's essentially what's happening here. So the accounting gods out there, they say something, look, like if you have a machine and that machine becomes obsolete, well, then you have to recognize that loss in value. We call that impairment. If that machine becomes so obsolete that it's worthless, then you have to take it off of the balance sheet completely. So that's the difference between impairment, it's just a loss in value, and derecognition is just a wiping out of the value on the balance sheet. So notice in that introduction I said we talk a little bit about property, plant, and equipment. Boy, that's just such a dull term, PP&E. So how do we decide? Let me go back here. How do we decide if we impair or we derecognize? Well, this is important. There's no mandatory annual testing, but of course, the executive leadership team, they're going to know if their machine or their piece of equipment is losing value. Maybe 5 years ago it generated 100 million in operating cash flow, and then over the last 5 years it's 80 and 60 and 40 and 20. Well, there's a clear sign that something's going on. Look down at the bottom where we have signs: obsolescence, technological advancements, reduced product demand. I mean, there can be tons and tons of things, the tons and tons of signs that indicate that there should be a write-down for impairment. Now, how do you do this? Once you have determined that an asset has become impaired, well, remember our conversation back under the inventory learning module. Well, it's very similar here. Let's go back to our journal entry. So think about it. Let's suppose I'm Jim's concrete company and have a truck, and the truck is decrepit. Its four wheels are flat, and the engine doesn't work, and the concrete thing doesn't go around. So, but it still works just a little bit, right? I don't want to derecognize it just yet. So what do? What did I say? It was worth 100. Well, what I want to do is I want to make a credit. I need to credit a reduction in that asset, and I'll call that, whatever I want to call it. Say it's 20 or 40, so that reduces the value from 100. Let's say it's 40 credit, so then the value of the asset is just 60. And then the opposing debit will be some kind of an expense. We might call it an impairment loss, and that'll show up on the income statement. So this is the really good question here. Look at the embedded diamond point. Reduces the asset's value on the balance sheet and decreases net income on the income statement. So once again, I'm going to repeat what I said back in the inventory recording, is that if you know the journal entries, then you can answer balance sheet and income statement questions. And then, of course, don't fall for this trap. It's non-cash charge, so it's not going to impact cash flow. Now, what was my example earlier? What did I say? $40. So how do we compute that $40? Well, the international people and the U.S. people, this is another area in which they disagree. So let's work through an example here. So we've got a hypothetical company here, downturn in sales. So we need to figure out what that impairment is going to be. So on the balance sheet, 120 Australian dollars. Undiscounted expected future cash flows is 100. Then the present value is 90. Fair value of sold 95. Cost to sell is 5,000. So let's go ahead and figure out what that reporting would be under both the international and the U.S. standards. But let me just go back to this previous slide here and warn you that under the IFRS model, we've got to take the carrying amount minus the recoverable amount. We'll see that in just a second. But then, under the U.S. rules, we've got to figure out if in fact we have something called impairment, and then we need to figure out how to compute it, and that's going to be that fair value is going to help us. All right, so let's do the international one here. So here's maximum amount, and that's going to be the difference between the fair value. So let's go back here. There's the fair value of sold, 95, minus those costs of selling, versus the value in use, and that value in use is going to be the present value of those expected future cash flows. Those happen to be the same numbers in our example. So imagine that those numbers were different. So, just do the math and you get the 120. What was that? The carrying amount. So 120 minus the 90, that gets us 30,000. Now, look down at the bottom. This is super important here as well. Great exam question. I can't imagine the Institute would say, recalculate the depreciation expense after the impairment. That sounds like something that would show up on a CPA exam, but just make sure that you're aware that, we can't depreciate the value of the asset that we've already impaired. Like in my example, what was it, 140 down to 60? I still can't depreciate the 100. Well, that doesn't make any sense. We'd like to depreciate that, but it's not reflective of economic conditions. All right, what did I say just a minute ago about the U.S. people? What they do is make this determination. So the 120 is greater than the undiscounted cash flows of 100. So therefore, the impairment is going to occur. And so all we need to do is take that 120 minus the fair value. Let's go back here. There's that fair value of sold, so that's the 95. So notice the difference between the two. Here, this is 30 under the international standards, and under U.S. standards, it's just 25. Let's move from the impairment of physical assets to the impairment of intangibles. And the important difference here is to determine whether the useful life is finite, like the Honeycrisp apple patent, or the James Bond trademark, which I'm guessing that's probably infinite. I'm hoping that James Bond is around even after I die. All right, so the difference between the two is if the intangible has a finite useful life, then we're going to amortize it. If it has an infinite useful life, then we're not. Notice the difference in that final bullet point there. So under finite, similar to the physical assets, but under infinite, we need to do an annual asset impairment test. So what does that look like? Under the finite useful life, what we're going to do is we're just going to test this on significant occasions. So we talked about that earlier, right? The obsolescence or substantial decrease in the demand for that product line. And so all we're going to do is the same thing, that same journal entry that we did earlier. We're going to go ahead and debit, something called, I don't know, what did we call it earlier? Impairment loss, impairment expense, something like that. And then the credit will be just the reduction in the value of the patent or the trademark. If it's an infinite useful life, then we're going to test this annually, and we're going to confirm if that impairment occurs, if the carrying amount is greater than the fair value, which was similar that we just talked about earlier. Now, sometimes, and this will go back to my example with my Jim's Concrete Company, if I have a truck, I could hold it for use, and that's probably what I'm going to do. But sooner or later, I might want to sell it. So we need to make sure we know the difference between held for use and held for sale. Now, what that means is that I'm going to just decide to sell my truck for whatever reason. In the middle column there, example of reclassification, we've come up with this idea that we're going to sell a building that we no longer need. So in my example of the truck, I may just decide to sell it because it has wobbly wheels, or maybe I want to get out of the cement delivery business entirely. Look over in that purple column. This is exactly what we were saying earlier about this reclassification. We need to have an impairment test if that carrying amount is greater than the fair value. And then let's take out some selling costs. Then we need to recognize the impairment. And so the good exam question is probably not so much just, hey, tell us what's going on, but it sounds to me like this will be one of those statements or conclusions or remarks made by an analyst or a company representative. And then, what did I say earlier? This was important. So you can't depreciate and you can't amortize. That makes sense. Now, remember when we talked about inventory, when we were writing down inventory, and what happens if that inventory then recovers its value? We call that a reversal of impairment. You should remember this from our previous conversation, and those same rules hold true here. Look under the U.S. rules that if an asset is impaired and you reduce the value, it cannot be reversed if that is a held for use asset. If it's a held for sale asset, well, then it can be reversed. Now, the international people, just like with inventory, they allow you to do all that, but you can't recover it in excess of that original carrying amount. That should make sense. These are really good exam questions here, but I'm just going to go back to my rule of go ahead and work through the journal entry. If you work through the journal entry, you'll see that assets carrying value decreases. That makes sense. total assets decrease. That makes sense, which is going to impact equity over there, and that's going to be reflective in, stuff that happens on the income statement. So on the income statement, increasing expenses reduces net income, no cash flow statement. So this slide is a summary of what I've been saying a little bit earlier. Now, how about if we derecognize? This means that we're going to just get rid of it, right? Asset is disposed. How can you do this? Well, you can sell it. You can exchange it for something else. You can abandon it. You can distribute the asset to shareholders somehow. I think of that great Seinfeld episode where Jerry's car stinks of body odor, and so he takes the keys downtown and he shows it to two guys who look like car thieves, whatever, and he just throws the keys into the car. So he's abandoning the car. So there's the Seinfeld. See, you learned something about accounting by watching James Bond and Seinfeld. That was an abandoning. All right, so what about this derecognition by sale? So in this whole theme of what we've been talking about, you think you're going to sell you would think you were going to sell an asset because it is no longer as valuable. But notice in that second bullet point there, we have a gain/loss. Now, this particular learning module doesn't give us too much of an indication of if it is a gain and what kind of a tax liability shows up because of that capital gain. It's probably going to be a loss. I mean, if we're talking about impairment and then we're talking about the next step of derecognition, it's probably going to be a loss. And so look at that. On the balance sheet, we'll just get rid of it, but then over on the income statement, we'll recognize that loss, and it could be a gain. So we have gains or losses. Look for losses on the exam. And then if you want some extra information, you can go to the MDA. That's probably a good place. Now, how about if we abandon it or exchange it or spin off? If we abandon, all we're going to do is remove it, and that's going to be equal to the loss recognized. If we exchange the assets, well, then we need to, let's go back to my example with the truck. So if my truck is worth, let's suppose my truck was worth $50,000, and we have been impairing, and all of a sudden we're just going to throw it away. So we're going to exchange it. So now it's worth, let's say book value is $10,000, and so we replace that with something that's worth. We could replace it with another truck that's worth $5,000 or worth $15,000 or $50,000. So what we need to do is worry about the difference. So look at the second bullet point there. The difference between the carrying amount of the old asset and the fair value of the new asset. That makes perfect sense. If it's a spin-off, look down at the bottom, then we transfer all the assets over into the new entity. Here's a similar slide that we just looked at with impairment. Once again, just go ahead and look at all the journal entries, and these are very similar. You shouldn't be surprised that these are very, very similar. It's going to impact ROA, turnover ratios, profit margins, debt to equity. So here, let me go back here quickly. So if you know the journal entries for each of these transactions that we're referring to, and then you know what goes on in the balance sheet and the income statement, and then you know what happens to these ratios. You know what? It might be worth it for you to whip out your phone and take a picture of this one here. That might help you memorize this stuff. And now, how about this reversal? Let's go ahead and conclude this conversation. What we're going to have to do is disclose all of this. Remember, under the international rules, we can reverse this up to that original carrying amount. So we want to tell everybody about it. So we call these disclosures, what depreciation method is, how useful life is going to be affected, accumulated depreciation, all those kind of good things. Intangible assets, these are very similar, but we need to make sure that we say, and this goes back to a previous slide, right? Is it finite or indefinite? What kind of amortization? What's the lifetime, et cetera, et cetera. Disclosures under the GAAP, we want to disclose the gross carrying amounts and that accumulative amortization. That makes sense. All right, so how about these US GAAP impairment losses compared to the international, right? So under US GAAP, those reversals are not allowed. But if they are assets held for sale, then you have to disclose all of these things here. And this makes perfect sense. All we're doing is just telling our bondholders and our shareholders exactly what we did and giving the details. Here, take a picture of this one. This is a good one. So I had you get your phone out a second ago. How do these disclosures appear? And so here's a whole bunch of stuff here that you should be aware of. Let's go ahead and finish up with some turnovers. Fixed asset turnover ratio. Notice we've got average net fixed assets. So if you have to calculate it, even though the LOS doesn't say calculate, make sure you take the beginning and the end of the year and add those and divide by 2. So what are we trying to do? This turnover ratio, as all turnover ratios, we're trying to say, all right, we invest in these assets and we want to turn that investment over into lots of revenue. So what do we like? We'd love to see tons and tons of fixed asset turnover ratio, right? We want to spend $1 on a fixed asset and turn that into hundreds of dollars in revenue. That sounds like super operating efficiency to me, but we need to be super careful here because note in the denominator, that's net fixed assets. So if we have old assets, they have lots and lots of accumulated depreciation, well, that might be a sign that we need to replace those things. Now, I've said this before, but it's worth repeating. When you look at the fixed asset turnover ratio, when you look at all ratios, make sure you look at the trend. So let's look at fixed asset turnover over the last 3 years or 5 years. That's one part, and then let's compare it against the competition. Of the multiple questions at the end of this learning module, there's one on asset age ratio, and it's the second one here. So I would know these two. Average age of the asset base, that's an easy one to remember, right? Accumulated depreciation over depreciation expense. But then the remaining life, net property, plant, and equipment over depreciation expense. And there's a teardrop point of what I was saying just a second ago about the older assets. So go ahead and put those two equations in the back of your brain, especially since you'll need it when you look at those questions at the end of this learning module. Now, there are a couple of other asset age ratios that do not show up at the end of this learning module, but according to straight line depreciation methods, and you guys probably learned this back in your undergraduate accounting days, when you solve for straight line depreciation, annual depreciation expense, you take the costs minus any salvage value divided by the useful life. Well, in this case, we're just switching. What's that called? The product of the extremes equals the product of the means. That's how I learned it. And when I got to college, my math teacher kept saying cross multiply. I had no idea what he meant. Now, the learning module then goes on to give you a couple of other equations here, and I'm not quite sure how important these are. So I'm going to let you decide if you want to memorize these things. I think these two are the more likely questions on the exam. But if you have to come up with these numbers, think about it, estimated total useful life, you can just go to the balance sheet and try to figure it out. I think if you have just general math skills, you can use these here. Now notice we have that warning sign on here. Companies use other depreciation methods, varying useful lives. So the practically challenging means that I'm not quite sure that the Institute would ask you these kinds of questions, but they might say, oh, here's some stuff that we pulled out of the financial statements. What are the problems with it? And then here are the answers. So that makes perfect sense. And that takes us through these learning outcome statements. So I want you to go to the end of the learning module, look at some of those questions, and there are some vignettes and item sets in there. So these are really good. But if you paid attention during this recording, I think you'll do okay on those. So hey, thanks for watching, and good luck studying.